look at how amazing this 0 days to expiry narrative was, and look at how amazing it caught the crash. And you just have to laugh at some people thinking that that's a thing. This is the 0 days to expiry volatility right here. You can see that the volatility was rising nicely prior to the crash here, and everybody's pointing that out for some god-awful reason. Everybody's pointing that out and saying, look at how easy it was to get short ahead of time. And I don't understand. I mean, do they not do their work before they start opening their stupid dumbass mouths? But look at the volatility rising at the top edge here. Surely. Yeah, it's just stupidity. It really is just absolute bone-arse laziness to try and sell people on the fact that volatility on the zeros were rising, at that stage, and therefore you had this brilliant opportunity to sell for that massive sell-off. And people say, but I don't understand it. Volatility on the zeros was rising, and it would have given us a sell-off. All right, smarty pants. What was volatility doing here for this rally? What did volatility do for this rally here? Volatility was rising. So if we sold the rally here, you can see, yeah, we could have made some money on the sell-off, but we would have been better off buying it. So what's your point? Okay, so what about 0 days to expiry here for this rally here? It was rising as well. So what's your point? So if you followed the same bloody logic as these idiots, you'd have sold in here, you'd have been selling in here, you'd have been selling in here, you'd have lost just about all your money selling short with this rise in volatility. They don't do their bloody homework. There was a rise in there's always a rise in 0 day vols. Nearly always. Nearly every day has a rise in 0 day vols. If they don't understand that, they should not be selling bloody educational courses. My God. Sometimes you wonder, don't you? Sometimes you wonder about the abilities of some of these people that are selling shit. Look at every day on 0 day volatility, guys. Rising. What does that mean? That every day is a massive sell-off? Rising. Does that mean every day is a sell-off, Ab? Pretty sure that's not the case, is it? Pretty sure that's not the case. So these people don't have a clue, do they? They bend a chart to show something that actually isn't real. It's really actually quite, I think it's really bad that they actually even do this. I think it's really bad that people even bother thinking about this 0 days to expiry and thinking that that gives a sell trigger. It doesn't. What does give a sell trigger? What does give a buy trigger is relative value of anything, isn't it? It's relative value, and it's always about relative value. It's about how fast and how hard. What do we mean? Well, take a look at this. Is there any information on that chart that you think could be valuable? Any information that you think could be valuable in that chart? I want you to really think about this now as an analyst. I want you to think about these never-ending rising lines. Never-ending rising lines. Because they all rise, don't they? They rise here, 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 they rise here. So in other words, it's not about the rising lines, is it? It can't be about the rising lines. This is the problem. People think there's something in it because they see one example. They think it's like the white horse, Jack, that wins a race, and everybody thinks white horses are going to win races, right? It's that survivorship bias that you see one really good example of something and you say, well, that's it. That's the secret. I want to know what this does for me. I want to know how this is going to make me money. And the very next day, they see a massively rising 0-day line and they start selling top edge equities, and all of a sudden they've lost their entire account because of one example, because they don't know how it interacts with the business side of the business, do they? They don't know what it means. It's just a line at the end of the day at that point. So does anybody look at that chart and think that there's any information that they can use? Anybody look at that chart and think there's any information that they can use? Well, there are bits of information that you can use. Ab's absolutely right. The actual day speed is quite useful. The day speed, how fast is it rising, can be quite useful, because that tells us that there's a very, very, very large amount of 0-day volatility. Okay, so that can be very useful. Absolutely. What else? What else? What else? The fact that I'm asking what else would suggest that there is something else we can take from it. What is it? So what do you mean? What do you mean by getting the direction right? Every day seems to rally, so does that mean it's bullish or bearish? If every day rallies, is it bullish or bearish? Well, that would be a tough one, right? If every day rallies, it suggests that every day on equities is going to be a sell. So what do you mean about getting the direction right? There must be something else you can see in that chart. There must be something else that you can all pick out on that chart. Melvin, what do you mean by structure? Well, the things that we can pick out in the chart, the things that we can actually pick out in the chart is relative value. And what we mean by relative value is we know that if there's going to be a big volatile day, right? We always know if there's a big volatile day coming in. And we know that the vast majority of volatility is on the sell side, but not always. Because, for example, we come into a CPI number, right? When we come into a CPI number, we know that there's going to be a lot of volatility that day on the indexes, correct? Now, we don't know if that volatility is going to be buy side or sell side. We've got no way of knowing whether it's buy side or sell side. But what we can tell is it's going to be an outsized day. And therefore, in the vast majority of occasions, an outsized day is usually a sell day. Do you agree with that? But there's something else that we can still build from this. We can still think about the fact that an outsized day that's on the sell side would probably have diverging gamma, wouldn't it? You see that? You understand that? Because obviously diverging gamma is what creates a big outsized sell day. So if we start seeing that diverging gamma, we know that the outsized day is probably very heavily skewed to the sell side. So the one thing that we can actually take away from this is we can actually see what the volatility is doing on the 0-day to expiry. So for example, we can see that the open low close there is a lot higher, can't we? It's a lot higher, isn't it? The open low close is a lot higher. Now, obviously, the open is always going to be down and the close is always going to be up. That's what we know about this narrative. So the open is always going to be down, the close is always going to be up. But in relative value terms, sometimes that the relative value is down in that type of situation there, isn't it? You see that? Sometimes the relative value is down in that situation. So looking at it from this perspective, things change. So on a 0 day to expiry, with volatility rising like this on a 0, we now know that there's a high probability that this could be a slippy sell side type day, and to be more focused, very carefully focused on what? On the gamma. It doesn't need to be sell side, but it's more likely to be selling off of top edges, isn't it? And when we see volatility on a 0 day to expiry dropping like this, it's more likely to be a buy side type of day. Do you see that? Do you see the difference? It's more likely to be a buy side type of day. Does that make sense to everybody? So there's a relative value quality about this that a lot of people just don't see because they're too busy looking at the 0 day itself and not looking at the relative value of the 0 day. So when I now look at equities, if I now look at the equity price and I see the volatility rising like this, would you agree that that's more likely to be a sell coming into equities? Would you agree that you would be very, 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 very reluctant to buy into this high swing here and to be more inclined to sell into the driving phase to the downside here? So when this opens down, does it not give me a very, very high quality idea that there's a high probability that we should be able to make some money on the way back up again during that phase? So in other words, we start to get some real insights based on the absolute opening price of volatility. We get some more insights about the closing price of volatility as well, don't we? We actually get a lot more insights. So when we think about these insights, we can see obviously that there was something happened here. I mean, that's ridiculous. What happened here? I mean, that's really strange on a 0 day to expire there, right? That's a massive change. You know, but you can see it started with the fact that the open was higher than the previous open. What happened on equities that day? Well, you can see what happened on equities. You might say, but it was a big buy trade. No, it wasn't. It wasn't a big buy trade because the market opened here. Remember, the market opens in here. And at that stage, we don't know if it's bullish or bearish. It's about the same. And then when it starts to accelerate as fast as it does, I would be very, very, very concerned about buying in that phase. Very concerned about buying in that phase. Really, really worried about buying through that phase. And obviously, the volatility that came in after that was pretty crazy. Remember, this doesn't show sell side vol the way volatility does. It doesn't have that same negative correlation. If it did, every day would be a sell day. We've just established that that's the case. That's not what it shows. It's not a negative correlation. It's a speed correlation. So in other words, when you think about it in real terms, a very fast, and there's a lot of people talked about the speed of it. I've mentioned the speed. So when we know that there's the zeros are moving very, very quickly, you're more inclined to do what? RGL buys and RGL sells. In other words, you're buying from the inside out and you're selling from the inside out. You're trading to the margins, not from the margins. You're trading to the margins. You understand? So when we see this market really aggressively popping, we know it's going to be volatile. We just don't know which direction it's going to be volatile in. So when we start to understand that a little bit better, we start using this knowledge again. We can start seeing some pieces of information here. When I see a market that opens quite a distance higher, my first gut feel is that this market is going to be a sell at the open. You see that? My gut feel is it's going to be a sell on the open because it's opened with higher volatility, which normally means it's going to be a sell. But this looks like quite a low 0 day kind of volatility, doesn't it? It looks kind of low. And again, we can look at that and say, well, it looks like it's a sell at the cash open. Was it a sell at the cash open? Sure. Cash open came in and dropped like a stone. But the lack of pace on it suggests that it's likely to recover. Do you see how you can use the speed aspect of this now? If this was going to be a big sell at the open, this wouldn't have dropped back down again here, would it? This would have accelerated really fast from the opening bell. And you can see where the opening bell was right there. There's the opening bell, and it drops really fast on the opening bell, as we thought it would be, because it opened down. Sorry, it opened at that stage there. It opened up, my mistake. It opened up, so it's a sell trade. So I think it's going to drop down. But when I see it dropping down and I see this accelerating, I'm getting a feeling that this is going to keep selling. But then all of a sudden it stalls here. If this was going to keep selling, this should have continued to accelerate. And then when it does accelerate away from here, it's very slow in real terms, which means it's probably bullish. It's probably bullish. The zeros don't have an awful lot of interest in this. When you see it starting to accelerate here, you're starting to think, wait a second, this is a little bit more dangerous. You start thinking to yourself, with this acceleration here, you can see how slow it was here. If we just draw a reg line through that phase and we draw a reg line through this phase, it's quite different, isn't it? So now you're starting to recognize this late afternoon increase in the 0 days. And with this late afternoon increase, you'll be more inclined to start attacking the extremes. Yeah? You'll start thinking to yourself, I think we're going to start attacking an extreme area here. I think, and it could be buy side. I think we could be buy side in here, but I also think we could be sell side in here. So we see that change taking place, don't we? We start recognizing a big acceleration, and we start asking other questions. Well, where is the gamma? Where is the price of vols coming in? And we start looking to see whether the gamma is getting slippy. And you can see that into that balance, the gamma did turn a little bit slippy. A little bit, not a lot. And you'd obviously certainly not have been bullish. Certainly the idea is that you then have got involved in that sell-off there, made some nice money. So there is definitely information to be had. It's just not the information that you can see other people talking about, unfortunately. You know, so when you're looking at these ideas and you're thinking about these as narratives, there are stories to be had from this information. This looks dangerous. This looks really dangerous. That's not a small movement on the open, is it? It's not a small movement on the zeros on this one. And the thing is that might be because there's a big print coming out. There might be a big CPI print coming out. There might be a big non-farm payroll coming out. There might be a big number coming out in the US session. So obviously volatilities are going to be enhanced. So we're obviously very, very aware that that is not a great number to watch. That's a very, very dangerous looking number at the open. And again, at the open, my gut feel is that that'll probably be what? That'll probably be a sell cash open at that stage. And I'm always going to be watching to see if it is a sell at the cash open. And you can see in the cash open, you can see that the market tops out and sells off. And you can see that when the 0 day flattens out here, then of course that's not going to sell off any further, is it? When the 0 day stops moving, you're saying, well, where the hell is this going to? So when that starts to flatten out, you start getting a feeling that this might start rotating, because obviously if the 0 day is extending and it's extending quickly, you're trading from the inside out. So in other words, you're finding a balance, you're finding a mid price, and your trade should be basically the idea of buying if it goes higher and selling if it goes lower. When you see this rolling at the top edge here, right? When you see this rolling at the top edge here, you're now thinking rotational business. So you're going to be thinking from the bottom edge up, because it's at the bottom edge. If it was at a top edge, you'd be thinking about the top edge down, because it's at a top edge. So there is information to be had from this. When you see the 0 day starting to extend again here, you're thinking inside out. And when you see the 0 day dropping here, You're thinking outside in. Do you see that? So when you see the 0-day dropping here, you're now thinking to yourself, well, I think they're going to rotate from the outside in. And you start watching these highs to rotate back in. You see how it works? It's not about bullish and bearish. It's about inside out and outside in. Make sense? Now, I thought I'd clear that up because, as I said, there's a lot of people talking about zeros and all that kind of stuff. And from what I can see, it seems to be just a load of rubbish. And it's not really that sensible about what's being said about it. It's not an easy thing to figure out. You know, but when you see a drop in volatility like this, you're obviously thinking to yourself, with a drop in volatility like that, your first gut feel is this could be a decent day because it's a drop in volatility, which means it's more likely to be rotational. So if I find myself running into, say, a bottom edge or something like that, I'm thinking to myself, bottom edges, this would be a good day to be a buyer of maybe a bit of bottom edge business. I quite like the idea of that. If it fits in with the likes of the gamma lines and my price of volatility dropping, I like the idea of buying into bottom edges at that stage. So you can see at that stage there, at the cash open, which is right there, you can see that that rotation seems to make a lot of sense, doesn't it? It seems to make a lot of sense. You get a couple of nice buys at bottom edges. It looks good. But the volatility is still very, very low, which means you're still expecting it to rotate out of the top edges as well. You know, the volatility is still very, very low, so you're trading from the outside in and from the outside in. And obviously that's exactly what happens. It trades back down, and when vols start to move again, you're thinking, okay, just be careful here, guys, because we're starting to see a trade that could be from the inside out again. And obviously the inside out starts to brew here, and you start seeing this fast push because we're trading from the inside back out again at that stage. But it slows down again, and it gives you a rotation off the lows. Gives you a rotation off the lows. Yeah. So you can see that this goes up, and when it starts going down here, it accelerates big style. Big style acceleration, because it's trading from the inside out. And that's why you're getting that big acceleration on the price level, on the zeros. You understand this? It's not the easiest, but think about it from a historical volatility idea. If you think about it from historical volatility rather than the concept of volatility that we understand in terms of trading, life a little bit easier. Very, very low volatility days here. See it? Very low volatility days. Very, very small, very, very low volatility. Probably pretty strongly bullish. Would you agree? Pretty strongly bullish. Bottom edge rotational type days. Bottom edge rotational days. Did that work out for you? Yeah. So it was pretty easy, wasn't it? It was pretty easy to get that read. Pretty easy to get that read about the market being probably more likely to be buy-side volatile, which means probably a little bit of a grind higher as a normal type of day develops. A normal type of day, not a big outsized day, but a normal type of day develops, yeah? Nice acceleration here, suggesting we're likely to get a volatile push to the upside. We get a volatile push to the upside. It's a pretty reasonable day. If we get too much of a push, then of course it's probably going to start rolling over and becoming very bearish, because that's where we get the big spikes and vols. So when we see that that's still very, very low, and that's obviously very low, I'm thinking a solid buy-side type of day is going to take place. Again, I'm able to make a very high quality, very, very simple read based on the speed and relative value of these vols, right? Based on the speed and relative value. And another very low volatile day and a very, very big outsized volatility day. Do you see it? Very, very big outsized volatile day. But you can see what happened. It was higher, wasn't it? having several successive days of lower volatility, this day opens higher slightly, not by much. But by this point here, it's already taken out the volatility of the previous day. Do you see that acceleration here? You see that acceleration there? That's worrying in any world, right? That 0-day acceleration from that point is genuinely starting to become very, very worrying. So you see that big worrying 0-day acceleration there, and you're saying to yourself, if the gammas are getting slippy at that stage, I need to be very, very mindful of the fact that that's a dangerous looking day. Did the gammas get slippy at exactly that point? Yes or no? The gammas got very slippy, didn't they? And that's why the zeros picked up massively here. Do you see that? That's why the zeros picked up massively, because the gamma got very slippy. So when the gamma got very slippy there, equities hadn't even really started to sell off. They hadn't broken structure yet. You see that? They hadn't even broken structure. But if you see this here, are you trading from the inside out or from the outside in? Inside out, right? So you already know straight away that you're trading from the inside out, which means that you're going to be looking at a sell at the bottom edges. You see that? Do you agree with that? And that's where you got your big splash there. Because you understood this as a process. You understood this as a narrative. You understood this idea of volatility on the 0-day world versus the normal volatility. Because the 0-day volatility always rises, pretty much, almost exclusively. The 0-day vols always rise on the 0-day vols. And therefore, it's not about the fact that it's rising, which makes it bearish. It's about the pace, and it's about where, and it's about what else it's causing, where else it's giving us knowledge, where else it's having an impact. So when it ties in with other tools, and there's the secret, when it ties in with other elements, when it ties in with other tools, it becomes useful, it becomes tradable, and we can start to make inside out reads or outside in reads. And we start to get that feeling when we see where vols open each day. Now, vols are about to open today, so we're just about to see what the vols do on the open, right? And that's what we're trying to figure out. Is it going to be a big volatility day today, or is it going to be a low volatility day today? So there's your zeros, right? There's your zeros. You've got the idea that the volatility was still very enhanced at this stage, but it became a very low volatility day yesterday. Low volatility day. So obviously it's just about now watching the elements, seeing where things open, seeing where things go, see where things develop, and if it's of interest, then tie it in with things like your volatility narrative. Tie it in with the volatility storyline, tie it in with all the other elements that go on in the background, tie it in with the price of vols, tie it in with the price of gammas, tie it in with some of the rotations as well, and things become a little bit clearer, a little bit smarter, guys. That's all we're trying to do, right? We're trying to just recognize that there's a reason for these stories. It's opened a little bit lower. No, it's opened a tiny bit lower, guys. Tiny bit lower than yesterday, suggesting that it's not expected to be a high vol day today, right? So immediately we've already got an idea that where it's opened is lower. It's already now set. It's already given us some knowledge. It's already given us some information. And you can see when it's opened lower, equities are popping. Equities are already bid. So this knowledge is that equities will probably be buying off bottom edge rotations. That type of trade day so far, and it can change very quickly as it did yesterday or the day before. So we can already see that knowledge is visible on the basis that on the cash open here, we've already seen a buyer coming into equities. We've already got a buy coming in. We've already seen an upside pop on this, which is very nice. It's just one of those other things, guys. It's up, you know, I'm not asking you to use it, and most people probably not use it, but it's just another piece of information to try and understand the concept of volatility, because it's a subject in its own right, isn't it? The whole concept of vols is an entire week-long classroom in its own, just simply trading against the price of volatilities in your indexes.